Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, and I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com, and today is Tuesday, and it's the 12th of April 2022. I'm just going to bring up a high-risk investment warning. I'll keep this on screen for a few moments. Hey, Zanetta, good morning to you. Nice to have you on the webinar as always. And thank you everyone for joining. Let's just bring up our market commentaries disclaimer. Hey, Michael, morning to you. Nice to have you on the webinar as well. All right, and here's our references, MarketScope, CNBC, and TradingView.com. We'll take a look at the US 10-year in a moment. I just want to get through the CNBC morning note. Hey Anna, morning. Nice to have you on the webinar. Thank you for joining. All right, let's go through the CNBC note here. The headline reads as follows: European markets set to drop as investors watch inflation and central banks. And it starts off by reading, European markets are set to drop Tuesday as traders look ahead to key central bank meetings and US inflation prints. Global investors will be watching the US Consumer Price Index reading for March. Now, this is important. The CPI is coming out. What times are coming out? It's coming out 2:30 ZA time, 1:30 UK, and the headline number is it's forecast to be a big number, 1.2% month on month, compared to 0.8% for last month. So that's expected out this afternoon. All right, and we just want to see also the producer price index, which will be out tomorrow. And this is all to assess how drastic the Federal Reserve has to be to rein in inflation. We already know that they are incredibly aggressive at the moment. 50 basis points priced in for May, and most likely 50 basis points in June, and even some talk, although I think this is remote, of 75, but I think that's remote. Okay, earnings season also is going to kick off this week, and we're going to see JP Morgan, Goldman Sachs, all the banks, Wells Fargo, Citi, Morgan Stanley, and again, I think this is important. The banks tend to set the tone for earnings season. The first quarter I would expect to be challenging because of the geopolitics. IPO activity is well down, and we want to see the forward guidance for the banks as well. So I think that may add some pressure when those get released. In Europe, investors to keep an eye on developments in the Ukraine. Russia's invasion of the country has caused volatility in oil and other commodities. That's disturbed stocks. Overnight, UK Foreign Secretary Liz Truss said her government was working urgently to verify details of an alleged chemical weapons attack in the besieged Ukrainian city of Mariupol. European central bank policymakers will meet in Frankfurt on Thursday to discuss the next monetary policy move. Faced with the tough task of weighing surging consumer prices against downward pressure on economic growth from the war in Ukraine, and Europe much more exposed to the stagflationary pressures. On the data front, UK employment data is out. I actually would expect it's out. In fact, I know it's out. And the claimant count came in better than expected. with the unemployment rate coming in at 3.8%. So I know that is out. We're also going to get the German ZEW Economic Sentiment Index, which is due out at 10 a.m. London, 11 a.m. ZA. Right, so that's the end of the morning note. Hey Katie, yeah, nice to have you guys on the webinar as well. So the chart we have in front of us is the weekly 10-year yield. And you can see that, we looked at this yesterday, you can see that it had this inverted head and shoulders, which we monitored. We looked at the breakout, we put in a measured move, although the measured move it's kind of cute when it gets hit. Nevertheless, it looks like it's about to be hit, right? It's at 3%, and the current yield is at 2.82% roughly. But what I want to point out here is that we are overbought. Okay. We are overbought here. That's in the weekly chart. In terms of timing, weekly charts are not particularly useful. I mean, something can stay overbought for a few weeks, and if you are holding on to a position for a few weeks and it is against the market, well, it's not going to help very much. So, but it does tell us that there is certainly an anomalous increase in the yield. Now, let's just explore that a little further. And all right, so what we'll do is we'll put in a trend line. Yes, this is okay in terms of gradient. I don't think that there's anything particularly worrying about this black trend line. So what does a trend line do? Let's get rid of this neckline. Let's clean this all up. So what does a trend line do? It's really a measure of momentum. It's not a measure of trend, despite what anyone says. It's not. Is it a measure of support and resistance? In my opinion, no. Some people say it is, but you would have to be acknowledge that it is gradient. You'd have to acknowledge, because we've got a y and we've got an x-axis. So if we can acknowledge that it's a gradient, then we can determine momentum, because gradient is measured by change in y over change in x, which is effectively momentum, right? If that is the case, then there's got to be rules. We've got to have rules about drawing the gradient. You can't just put a gradient in. For example, why can't I just put a gradient like this? Okay, so there's got to be rules, and there are. We won't go into all of them right now, but we clearly want to connect all the troughs. But you can't connect the troughs unless they are validated by a peak. So this trough is validated by this peak. Okay. This trough is not validated because it's a lower peak. Okay, so let me just put in the labels here, because this can be a little confusing. We're using this. So let me try that again. We're using this as a reference. Okay, as soon as we've got a peak, that would validate that trough. Okay. Now, the word trend line, although it doesn't determine trend, a trend line doesn't determine trend. A trend does determine trend line. Okay, so we've got the higher trough here, Okay, so a high drop. This is the lower peak. Okay, so it's not going to, doesn't validate, but this trough gets validated. That trough gets validated because here's the higher peak. All right, I hope that's sort of making sense. The trend line can only be drawn if there's a trend. A trend is determined by peaks and troughs. There's a definition for a trend in terms of peaks and troughs: higher trough, higher peak. Okay, now what you can do is you can actually shift this over here. And shift it. And why can I shift it? Because here is another higher trough, and it's still validated by this higher peak here. Okay, and we're getting to a point now where we're looking for the next shift up in trend lines. I don't have a trough here. I don't have a trough here, so this is not a correct trend line over here. But the point is, it does look as if gradient is increasing. Now, as a general rule of thumb, in terms of momentum, if you can get 3 shifts in trend line, you're probably looking at an overbought market. If it's 3 shifts, where the gradient's getting steeper to the positive. If it's getting steeper to the negative, then you probably have an oversold market. Now, so we do have an increase in the momentum here. Once we start getting to 3, probably getting to an overbought market. You can already see that is the case with the RSI. So the obvious question is, well, you know, it's a big statement you're making there, Russ. Why would 3 shifts be overbought and not 4? Well, clearly, if 3 is 4. But the point is, it's just a general rule of thumb. It's not an absolute. But once you get to 3 shifts, you're probably looking at an overbought market. How so? Okay, so let's just bring up Microsoft Word. How so? The key here is to understand what we're looking at. Okay, trend line measures gradient, okay, as mathematical properties. Okay, it's not a determination of trend, it's a result of trend. Okay, so what we're actually looking at is we're looking at change in Y, okay, have a change in X. Okay, we'll put that into English in a moment. In other words, what we're looking at is we're looking at the increase in Y. The increase in Y, what is Y? It's usually price. It's usually price. Okay, in this case, it's interest. Okay, so we'll put in price here. Okay, what is the x-axis usually? Okay, that's usually time. Okay, on a price chart, it's usually time. So what we are effectively doing when we get a steeper, so this is a gentle increase in price over time. That's probably manageable in terms of market action. Okay, you kind of get a, let's just shift here. You get a shift here. Okay, there's still, now you're getting a quicker. So you're getting a quicker change. You're getting a, let me say that again. You're getting a more intense change in Y in a shorter period. Okay, so you're getting more gain on the Y side, and there's going to be less on the X side. What happens if you go like this? Let's actually go to the extreme. Let's do a vertical. Let's do a vertical. We'll make the point using an extreme. Let's say that there's a shift, and the gradient has now turned into a vertical, which would be interesting, by the way, because this would have a, believe it or not, it would have a undefined gradient. But nevertheless, the point is, okay, is that how can you maintain this type of a gradient? Okay, how can you maintain that in terms of the time? Think about it in terms of a steam engine. How much coal do you have to put it into the steam engine to get up a very steep cliff? Okay, and what happens if you've got a limited supply of that coal? Eventually, okay, it's just going to overheat. You wouldn't be able to either it's going to run out of puff, okay, it's going to run out of coal, or the engine is going to overheat. That's effectively what gradient is measured. That's what gradient's measured. So what we're doing is we're looking at the sort of the heat here, and it's getting to a point where it's looking overheated. Now we go down to the daily chart. Okay, and we actually can stick in the shift here, and we've got the RSI telling us that we are overbought. So what is this all telling us? Well, the reason that we've put RSI, the reason that we're putting these conditions to measure heat, so to speak, is really to give us a measurement of risk to reward. We're never ever going to be able to get anything exact off of these indicators. Okay, we can only refer to probabilities and hope that they pan out in our favor. So what I'm saying is that the risk here, okay, is of a pullback. There has to be some sort of normalization. There has to be think of it this way, our metaphor. The train needs to stop to get reloaded with coal. Okay, once it's got the coal back, we can start that ascent. So right now, what I'm thinking is that we've got a very we've got a skew in risk is effectively what I'm saying. So what's the big deal about this? Why am I making such a sort of a big deal about this? Why am I emphasizing? It's because we've got a very important data point coming out today, and that would be CPI. Why is it such a big data point? Because that's what everyone is talking about in the markets. We're all talking about inflation. We're all talking about how inflation is very serious. It's blown out beyond all targets. The Fed is needing to be extremely aggressive. And what I would suggest to you, and this is I'm gonna say subject to correction, because it's a very difficult market to make these type of assumptions. But what I was suggesting to you is that when the CPI comes out, expect volatility, unless it is some huge blowout figure. I would also think that a large part of that number has already been priced into the market. In other words, how does a yield move up like this? It's very well, one of the mechanisms is you're just going to sell down, you're going to sell bonds short. So we could just go to IEF, which is an ETF of the 7 to 10 years. We'll bring that up. Okay, and you can see whoever has sold the IEF short, well, they are holding a serious amount of cash now. So the idea here is if you are short bonds, and you are now of the opinion that a lot of the inflation has been priced into the market, if you are also expecting a number today that would bring other short sellers into the market, wouldn't you think that's a perfect time to cover your position, especially if it's a large position? In other words, expect that initial volatility, expect that initial volatility. But I wouldn't be surprised if there's some sort of contrarian move here. In other words, we see interest rates actually pull back in the face of a higher inflation number. And the market's going to be thinking, well, what's going on? It's because last week, the pros were already discounting today's CPI last week. Okay, so they've made their cash for this week's print. Now, this is all obviously a huge assumption on my case. Yesterday we called it a base case. So when you've got a base case, well then you've got two sides. You've got two sides to that base case. You've got either a best case scenario or a worst case scenario, right? So it may not pan out this way, but what I would say with a fair amount of certainty is that there is a skew in risk. So even though there is most certainly going to be a high CPI figure, the action post that will be volatile, but then we go uncertain. Does the market carry on shorting because they know that the Fed is going to be aggressive, or has that already been priced in? See, has that already been priced in? Now, in terms of markets, okay, and this, what I'll say next, can be debated ad nauseum, but I would posit that the markets are perfectly efficient, okay? And if you speak to most technical analysts, they'll say the markets are inefficient. I'm not of that opinion. I'm of the opinion that the markets are perfectly efficient. Where the inefficiency occurs is in the information flow, okay? So the market's just pricing in the information that it has. So, but it's forward-looking. So we knew last week there's going to be inflation. We knew that this week the CPI is going to print, okay? So we price for that, okay? The moves happen. Buy the rumor, sell the fact. You guys ever heard that? Okay? Buy the rumor, sell the fact. So this is one of those situations where you may see price moving in a funny direction. And the reason is, well, how come? It's because it's buy the rumor, sell the fact. So I want everyone just to be very cautious if you're in the market today, because if the yields do pull back, in other words, how would yields pull back? Let's just understand the mechanism here. So shorts, any shorts, okay, that want to now start banking profits, they're going to have to cover their shorts. How do you cover your short? It means that you are buying back, okay? You're covering your position, okay? So who would they be covering the position with? Well, that would be the guys that are lagging, the guys that should have been short last week, okay? So in other words, there could be some sort of volatility, then the bounce, okay, then the pain for the guys that are late, and then the next leg down. Now, if we get this type of a bounce, well, you just go back to the US 10-year, okay? So you get to the US 10-year, and you could probably see, let me change probably to possibly see this type of a movement. Pull back, and now the market's thinking, why is interest rates coming down? We've had a blowout. That's just because the move's already happened, okay? Whoever's in the market goes late to the party, okay? And then the pros get back in. So I do think interest rates are moving higher. It seems that it has to be that way. But we know that markets don't move in a straight line. They zig and zag, specifically because of these type of anomalous events when everything's already been priced in before an announcement. Now, if that is the case, if this is what we're going to see, now I've got to be very, very honest with you guys. I don't know that's what's going to happen. It's just what I expect to happen, and I could be dead wrong. Okay? I could be dead wrong. It's just an opinion, but it just seems that this looks like an opportunity where the market has really run too hard in such a short period of time. Okay, the gradient is telling us how much coal is left in the market for this particular swing. Doesn't the train have to refuel, so to speak? Okay, so And it's just something that to keep in mind. Now, if there's the case, all right, well, I've got Bitcoin here, all right. Now, what could potentially happen here with Bitcoin, okay, is that we might find some sort of support. Why? Not for any other reason except for an anomalous profit taking by the bond market, which pushes yields down, pushes dollar down, and potentially pushes Bitcoin up, okay, which would be quite bizarre. Why would Bitcoin be moving up when inflation is so high? It's because of buy the rumor, sell the fact. Now, this is a very big call that I'm making, because if you go through to the daily chart, yesterday was an awful day for Bitcoin. It really fell and crashed into zone 3. I wouldn't be surprised if we end the day in zone 2, but just keep an eye on that. Okay, what I'm saying is, and this is really the most important part of this whole discussion, is that risk is skewed. If you're participating in the market at 130 UK, 230 ZA, you're exposing yourself to potential risky moves that are going to go adversely against you. You might be on the right. You might be on the right side. Don't get me wrong. You might be on the right side, but it's a very risky type of market. Now, you go down to, say, the DAX, and we'll just see how the DAX is opened here. And you can see the DAX has had this really rough movement down. We're back into zone 3. You can see that the Bollinger's are squeezing. So something's about to happen in DAX, right? Now, let's just assume that there is some sort of profit taking that takes place. And we get back into zone 2, okay, that still wouldn't negate, the bear market rally scenario, okay. We've still very much got this, but it would set up something that Bollinger does talk about, an initial fake impulse. In other words, what Bollinger talks about is when there's a squeeze, he does note that often the market moves in a direction adverse to the ultimate expansion in volatility. This might be that case. So whilst I am of the opinion interest rates are heading higher, US dollar is probably going to move higher with it. Bitcoin will be under pressure from the denominator side. Risk markets will be under pressure from the rate, because the rate of return is in flats. Okay, today might be an anomalous day. Today might be a tricky day. And I want everyone just to be very, very careful. If you are in the markets, just make sure you've got your risk management strategies in. That includes position size management, and stop loss management. Yeah, and Pete's agreeing. So he says the CPI is expected to be higher, but he thinks there could be some weird price action, and that's my point. There could be, it might run completely as expected. It might run completely as expected, okay? But why am I making such a big deal about this? I don't like this overbought condition heading into this big announcement, okay? So we just want to be very, very careful. If there is if there is a pullback here, well, then we watch the dip, because then there's a dip in the uptrend, so to speak, when we're talking about yield. If you're looking at it in terms of bond prices, well, then there's a rally and a downtrend. So that's kind of the approach that sort of I'm favoring at this moment. I have to, say that it's subject to correction, because it's a very tricky market indeed. All right. Any comments? Please go ahead and type this through. Any comments? Go ahead, type this through. Yes, I did see that, Katie. I beg your pardon. I will answer your email today. I did see it. Yes, I beg your pardon. Okay. All right, guys. Let's wrap up here, and then we will chat tomorrow, and we'll see how close was I to the mark. Okay, just before we go, Rob, very nice to see you on the webinar. Rob writes, the 10 fives are still inverted. At some point, must normalize. So we should expect an even bigger drop in the 5-year yield, or will it stay inverted for longer? That's a very, very good question, tough question. I generally don't look at the 10.5s, Rob, but I'll look at them now. I do look at the 10.2s. Let's just see what's happening here. All right, so what's happening here? Okay, what's happening here is the movement in the 10-year. So the movement in the 10-year has effectively caught up with the movement in the 2-year, and it's pushed it from inversion sort of. It's still very flat, but it's no longer inverted. Let's just take a look at Rob's 5-year here. All right, so clearly it's still inverted. I can see it's a minus 0.01, so it is inverted, albeit still is flat. The point is that the 10.2s inverted, the 10.5s have inverted. The problem with these inversions is that they tend to signal weakness up ahead. What they say about inversions is that every recession is preceded by an inversion, but not all inversions lead to a recession. So the question here is, which one is it? The fact that there has been inversions here is clearly a worrying sign. So the question is, how does the 10.5s move back into sort of a steepening type of bias? Okay, so let's think about it, I guess, one day at a time. Just today's going to be a tough day. If there is some sort of pullback in the 10 years, right? If there's some sort of pullback in the 10 years, then of course the inversion, one would think, would continue, right? Because the only reason we've got these two blue candles here is because of the really strong last 6 weeks in terms of the 10-year, and what's been driving that 10-year has really just been huge aggressiveness by the Fed. And I'm going to say not so much the tightening by the rates. I don't think that the rate hikes are actually influencing the 10-year as much as the prospects for quantitative tightening. So quantitative tightening is coming. There are problems with quantitative tightening in that, well, how's the Fed going to deal with its mortgage-backed securities? But again, conversation for another time. I think that ultimately we do see higher 10 years, probably more sensitive. I'm thinking here, strange enough, Rob, that there's more sensitivity in the 10-year as opposed to the 5-year because of the QT. And I think that the balance sheet, we're looking to start normalizing that from May, so it's fairly soon. I think then if we go back to the US 10-year, I think what effectively happens here, Rob, is that the 3%, which was our measured move, is exceeded. What would be interesting is the pace, the rate of change between the 10-year and the 5-year. If the QT results in a pace of increase in the 10-year that is greater than the pace of the 5-year, then it should steepen. However, it doesn't nullify the fact that there was a slight inversion, does it? The question is, what kind of a recession would we head towards once QT is in motion? I'm of the opinion that it does impact employment and growth. The question is, how robust, how resilient is the job market right now? The job market's actually fairly strong now. And I think the Fed is betting on that to offer a soft landing, because they're going really all out in terms of this aggressive tightening policy. So I think what you'll see is, whilst the 5-year may drop, that's certainly a possibility. I'm of the opinion, and again, subject to correction, that the inversion is not corrected from the 5-year so much, but corrected more from the 10-year side of things. How so? Quantitative tightening. Does that answer your question at all, Rob? I hope it does. It's all supposition, but I think that's the way that it's going to play out. All right. If there are any other questions, yeah, exactly. Let's wait and see. Rob says, let's indeed. All right, guys, let's wrap up here. You have my email addresses. I know KD is waiting for a response. I'll get that response out to you today. And have a good day, good evening. We'll check you guys tomorrow. Thanks very much.